10 years to the day since interest rates last went up. Since they've hit record lows, Ben's looking at what it means for everyone.
Yeah,
Morning.
10 years, can you believe it? 10 years to the day since they last went up. Thanks very much. Yes, of course, interest rates are set every month by the Bank of England, but the last time they went up was 10 years ago today, July the 5th. 2007, as Louise says. Since then, they've hit record lows. I've been looking at why.
The cost of borrowing affects us all. It determines what we pay for our mortgage, our credit cards and our loans. And it also sets the rate that we get interest on any savings. So take a look at the last 10 years, and one thing is pretty clear. Rates have been going in one direction, and that's down. And it all began at the height of the financial crisis. The UK economy was put on emergency life support to keep it ticking over while the world's financial system was in turmoil. Between 2008 and 2009, rates were slashed from nearly 6% to just a half. And they've been at those record lows for a very long time. And just when people thought rates might start going up again, the Brexit vote created even more economic uncertainty. And so rates were slashed again in August last year to just 0.25%. Low interest rates mean it's cheaper for businesses to borrow money to invest or expand. And it also means cheaper mortgages, loans and credit cards for all of us. But at what cost? Well, it's bad news for savers. They've lost out from record low returns, and low interest rates tend to push up inflation. And so that means higher prices for everyone.
So that's what's at stake. Let's speak to Dr. John Glenn, who's from Cranfield School of Management. John, good morning to you. I touched on there in that little explanation about why interest rates have done what they've did. I described it as life support for the economy, and it really was. If we think back to 2008, the economy was in turmoil and the Bank of England needed to do something, and this is one thing that they could do.
Yeah, the economy was collapsing as a result of the financial crisis. We made the extreme move to cut interest rates to historically very low levels. That allowed the economy to grow. So at the back of 2010, 2012, the economy grew as strong as any economy globally, really, of our size and our maturity. So it was quite a successful policy.
And when we see that rates have stayed so low for so long, I mean, since what, March 2009, since they were cut to that half of 1%, I mean, it's incredible that they've been at that level. And a whole generation now of borrowers who've never seen an interest rate rise.
Yeah, I think it's 2.5 million households who've got mortgages have never experienced an increase in that mortgage rate. So they're used to paying very, very low rates of interest. And obviously, if interest rates were to increase significantly, that would impact their household budgets in a very meaningful way.
Yeah, and for people who've never seen that increase, it would come as a big shock, I suppose, that the amount they're paying every month on their mortgage or their credit card or their loan is going up.
It would go up, but we have to be realistic about it. If we were to see 0.25%, 0.5% increase in interest rates, that would be something most households could cope with. If we were to go back to the 5.75% interest rate that we were paying 10 years ago, that would be an enormous strain on household budgets.
OK, so where are we? Because we've seen that America has now started raising its interest rate. There's pressure for other countries to sort of do the same. And the Bank of England, a few on that rate-setting committee thinking now might be the time to start doing it.
Yeah, the vote in June was 5-3 to keep interest rates, so that people are starting on the Bank of England Monetary Policy Committee to think that it is now time to increase interest rates. We're seeing an economy that is very close to full employment. There are dangers of inflation because of Brexit and increased import prices. But then on the other hand, we're seeing relatively poor growth of around 1.5% this year and next year. So the worry about growth at the minute is overriding any worries that the Bank of England has about inflation.
Yeah, I want to talk about inflation because we've seen that starting to creep up now as well. Yeah. And cheap money means that we'll go out and we'll spend, and that's what's pushing up prices. And that's the flip side that I mentioned in that little report.
Yeah, it is. But at the moment, the inflation is being caused by a reduction in the value of the pound and imported inflation and external factors, you know, commodity prices, oil prices, although they've abated recently. So at the moment, the Bank of England thinks that on balance, the inflation worries are less than the worry about growth going forward. OK, and what happens next then? It is the million-dollar question, isn't it? When do rates start going up? Rates start to go up when the economy starts to recover. So we would see an amount of recovery once we recover from all this Brexit uncertainty, probably into the end of 2018. You might see one or two very minor 0.25% increases over that period, but it will be post-2018 before we actually see any significant increases in interest rates.
Gives us plenty to talk about. Until then, Dr. John Glenn, thanks very much from the Cranfield School of Management. More about that from me after 7. I'll see you then.
Talking about lots of anniversaries today, 80 years since Spam came into the world. It's 10 years today, perhaps more importantly, since interest rates last went up. Since then, we've had record lows, and Ben is looking at what this means for us all this morning.
I don't know. Spam's kind of interesting.
Spam is big news.
Thanks very much. Morning to you too. Yeah, we're talking about interest rates because, of course, they're set by the Bank of England every month. But the last time they went up was, well, 10 years ago today. That's July the 5th in 2007. Now, since then, of course, they've hit record lows. So Sarah Coles is with me. She's personal finance expert with AOL. Sarah, morning.
Morning.
So 10 years that they've been, I mean, they came down 2008, 2009. They stayed at 0.5% for so long. And then that cut last year, of course, after the Brexit vote, to just a quarter. Good news if you're a borrower, but terrible news for savers.
Yes, it's been a really terrible decade for savers. I think if you looked at the rates in about 2007, you could get about 6% as a best buy rate. Now you're looking at 1.25%, which for those people who are trying to live off their savings, particularly pensioners, it's been really, really difficult. I think some of them, particularly if you look further back, were actually looking at double-digit rates when they were first looking at retirement. So this has made a really dangerous, difficult time for them.
And it really does show that on one hand, you know, some people will win and others people are going to lose. Some would say it's the price that some have had to pay to keep the economy on an even keel, because the Bank of England, of course, cut rates to try and keep the economy ticking over. It was likened to putting the economy on a life support machine by slashing rates so low. Is that a fair assertion that some are going to lose, but it's just the price we pay for keeping the economy going?
Well, it's a difficult one because it does mean that borrowing has become a lot more affordable. I mean, it is the era of cheap money, and that means that people have been able to make ends meet a lot better because their mortgage payments have come down so much. So if you look again at typical rates, 2007 it's about 5.8% for a typical mortgage. Now it's about 2.6%. So that is a big saving for people's households. I think the problem comes when you're trying to drive an economy through borrowing, because people will then just load up more on debt. So if you look at borrowing at the moment, we've got about £1.3 trillion worth of mortgage debt compared to 1.1 back in 2007. You look at consumer borrowing's gone up as well. So we've loaded up on debt, which gives us a problem when the Bank of England are looking at raising rates, because then people are having, there's 8 million people who've never experienced a rate rise in their adult life, and suddenly they're going to find they're borrowing more expensive, and it's a question of whether or not they can deal with it.
And what does it do for the psychology, for people that have never seen a rate rise? I suppose there are two things. One, we assume that money is going to be cheap for a long time, but also there's very, very little incentive to save.
Well, this is why savings rates have fallen to record lows, because people don't see any point in putting their money away for 1.25%. I think partly what the aim of the Bank of England is, I mean, the reason why they're talking about making the changes now is so they can make changes very slowly, so people can get used to small rises. I think one of the other changes, obviously, they've been trying to do is to make sure that people who borrow money now are taking much more stringent tests so that they can make sure they can afford them. But still, psychologically, it's going to seem very strange to people, especially when it's not like they're suddenly left with loads more money in their pocket. They've actually had their money squeezed elsewhere. They've got more expensive in the supermarkets. There's gas bills, there's cars, everything is much more expensive now. So I think where the bank was hoping that you'd have this sort of free money and then suddenly you'd be able to reallocate it back to your mortgage, it really doesn't work like that in practice. So I think there is going to be a lot of pain to be felt.
Sarah, thanks for explaining all that. Sarah Coles, our personal finance expert at AOL. More from me after 8. See you then.